Hello everyone, welcome back to our channel. Today, we'll dive into a significant monetary policy shift announced by the Central Bank of Iraq. Newshound guru Caperoni has reminded us that just 2 weeks ago, the bank revealed its plan to end the currency auctions by the end of the year. This move has far-reaching implications for Iraq's economy and its currency, the Iraqi dinar. Let's break down what this means and what we can expect. The current system, currency auctions. For years, the Central Bank of Iraq has been managing the value of the Iraqi dinar through a system of currency auctions. These auctions involve the bank selling US dollars to private banks and businesses in exchange for Iraqi dinars. The purpose of these auctions was to maintain a stable exchange rate between the dinar and the US dollar, which is crucial for facilitating international trade and managing inflation in Iraq's import-dependent economy. However, this system has faced criticism for being opaque, inefficient, and prone to corruption. Additionally, it has placed a significant burden on Iraq's foreign currency reserves, which have been dwindling due to lower oil prices and increased government spending. The proposed solution: floating the Iraqi dinar. To address these issues, the Central Bank of Iraq has announced its intention to end the currency auctions and transition to a floating exchange rate regime for the Iraqi dinar. Under a floating exchange rate system, the value of the dinar will be determined by market forces, primarily driven by the supply and demand for the currency in the foreign exchange market. This move is expected to bring several potential benefits. 1. Increased transparency and efficiency. A floating exchange rate is generally considered more transparent and efficient than a fixed or managed exchange rate system like the currency auctions. Market forces will determine the value of the dinar, reducing the potential for manipulation or corruption. 2. Conservation of foreign currency reserves. By allowing the dinar to float freely, the Central Bank of Iraq will no longer need to intervene in the foreign exchange market to maintain a fixed exchange rate. This could help conserve Iraq's foreign currency reserves, which are essential for financing imports and managing external debt. 3. Improved competitiveness. A floating exchange rate could potentially make Iraqi exports more competitive in the global market if the dinar depreciates against major currencies like the US dollar. This could provide a boost to Iraq's non-oil export sectors and support economic diversification efforts. Challenges and concerns. While the move to a floating exchange rate regime has potential benefits, it also comes with challenges and concerns. 1. Volatility and uncertainty. Floating exchange rates can be subject to significant volatility, driven by factors such as changes in oil prices, political instability, and global economic conditions. This volatility could create uncertainty for businesses and consumers, potentially hampering economic growth and investment. 2. Inflationary pressures. If the Iraqi dinar depreciates significantly against major currencies, it could lead to higher import costs and potentially fuel domestic inflation. This could erode the purchasing power of Iraqi citizens and negatively impact their standard of living. 3. Transition risks. The transition from the currency auction system to a floating exchange rate regime will need to be carefully managed to avoid disruptions to the economy and financial system. The Central Bank of Iraq's decision to end currency auctions and move to a floating exchange rate for the Iraqi dinar represents a significant shift in monetary policy. While this move has the potential to bring increased transparency, efficiency, and conservation of foreign currency reserves, it also carries risks such as volatility, inflationary pressures, and transition challenges. As Iraq navigates this monetary shakeup, it will be crucial for policymakers to carefully manage the transition, implement supportive economic policies, and effectively communicate with stakeholders to mitigate potential risks and capitalize on the opportunities presented by a floating exchange rate regime.